Greetings, everybody. Welcome to Liberty Call. Today is Monday, April 17th, 2023. Hope everybody's having a good day out there and a good weekend. My Astros did not play that well. They lost Friday and Sunday and got their asses kicked last night. So not the greatest weekend in the sports for me. Got a little snow on Friday. Well, maybe a little more than a little snow. And then it wasn't too bad over the weekend. But anyways, all right. If it's your first time watching Liberty Call, please give me some thumbs up, likes, shares, subscribes. I greatly appreciate it. And let's go ahead and jump into the numbers for today. Let's see here. Let me make this a little bigger for you. The Dow Jones today finished up 0.3%, 100 points. Closed at 33,987. S&P 500 was up 0.33%, closed at 4151. NASDAQ up 0.28, closed at 12,157. The VIX was flat today. It's currently at 1695. Canada was up 0.3. Brazil was down 0.25%. Mexico was up 0.59. Over in Europe, Germany was down 0.11. UK was up 0.1%. France down 0.28. Netherlands down 0.38. Spain up 0.17. Italy down 0.62. Switzerland down 0.27. And Portugal up 0.64. Russian exchanges both in the green today. MOEX up 1.61, RTSI up 2.21. And the overnights in Asia, starting with the Nikkei in Japan, it was up 0.07. Australia up 0.27, New Zealand up 0.69. And the Chinese markets appear to be all green. The Shanghai was up 1.42%. The Shenzhen component up 0.47. China A50 up 1.9. DJ Shanghai up 1.29. Hang Seng up 1.68. And the Taiwan weighted was up 0.21. All right, so it looks like everything today was pretty good. I'm not sure what everyone's so happy about, but, because the markets, unfortunately, are very rocky right now. All right, well, let's go ahead and jump on over to our weekly economic update and dive into that. Let's shrink that down. All right. The combination of an improving inflation outlook resulted in a week of uneven, albeit positive performance in which cyclical and financial stocks rallied while technology, real estate, and utilities lagged. The Dow Jones Industrial Average gained 1.2%. The S&P 500 rose 0.79. NASDAQ increased by 0.29%, and internationals were up 2.08%. All right. In inflation retreat, stocks treaded water ahead of last week's inflation data and the start of the new earnings season. Stocks rallied on favorable March consumer inflation report, only to falter after the release of last month's Federal Open Market Committee meeting minutes, which hinted at a potential recession later in the. Is this shocking news? I mean, who read the Fed minutes was like, it says here we're going to have a recession. Boy, this is news. God, really, people, come on, pay attention. After reports of a more pronounced slowdown in producer prices on Thursday, stocks surged higher, with technology and communication services companies leading the charge. A weak retail sales number on Friday shaved the gains to close out the week. Trending lower last week provided fresh insight into inflation, and the news was encouraging. The CPI rose a very modest 0.1% in March, while the year-over-year increase on consumer prices was only 5%, down from February's 12-month rise of 6%. Again, I love how they put lipstick on that pig. Declines aided the March report in groceries, gasoline, medical care, and utilities. The read on supplier prices was even more positive. The producer price index, which many economists see as a signal of future consumer prices, declined 0.5%, the most significant monthly decline since 2020. The 12-month increase as of March was 2.7%, and easing from February's year-over-year climb of 4.9%. All right, economic data this week. Tuesday, we have housing starts. Thursday, we have jobless claims, existing home sales, and the index of leading economic indicators. Friday, we have the PMI composite flash. We have a lot of companies reporting earnings this week. Today on Monday, we have Charles Schwab and M&T Bank. Tuesday, we have Netflix, Bank of America, Johnson & Johnson, Lockheed, and Goldman Sachs. Wednesday, we have Tesla, IBM, Lam Research, Abbott Laboratories, Morgan Stanley, U.S. Bank, and United Airlines. Thursday, AT&T, Blackstone, American Express, CSX Corporation, Union Pacific, D.R. Horton, and Truist Financial Corporation. And Friday is Procter & Gamble, HCA Healthcare, Freeport McMoran, and Regions Financial Corporation. All right, so that's the news on the street this week. There's also some tips for small business owners. Here, let me bring that back up. Let's see here, some healthy living tips and a riddle. All right. All righty, let's see here. Where was I? Okay. All right, well, let's go ahead and look at today's market recap. S&P 500 climbs as banks shine, but Google-led wobble in tech keeps gains in check. Get my notes up here. On Monday, the S&P 500 experienced a decline due to Google's slip and sentiment on growth corners of the market, particularly in tech, which was also affected by a surge in treasury yields. Alphabet fell more than 2% on reports that Samsung may ditch Google's search for Microsoft's Bing as the default search engine on its devices, endangering about $3 billion in annual revenue. Apple was also trading below the flat line, while Netflix slipped more than 2% ahead of its quarterly results. Netflix's earnings report was awaited with interest by Wall Street as some analysts expect updates on the company's crackdown on password sharing. Ooh, shame. I share my password. Well, actually, I don't think I have an account in my name. I think it's my wife's name. But yeah, we share it. Screw Netflix. Wall Street analyst. Okay, UBS commented in a recent note that they believe password sharing restrictions could provide an uplift to revenue and quickly turn accretive. The fear of further Federal Reserve rate hikes also contributed to the negative sentiment towards growth stocks. UBS predicts that a 25 basis point rate hike at the May FOMC meeting is likely, and an unexpected pause from the Fed would be driven by concern over the banking system and credit. Investing.com's Fed rate monitor tool shows the odds of a 25 basis point rate hike at the Fed May 3rd meeting are nearly priced in. Despite the negative sentiment towards growth stocks, financials buoyed the market as banks released their quarterly earnings. Charles Schwab rose more than 2% after reporting mixed results, while M&T Bank rallied more than 6% as its quarterly results beat expectations on both the top and bottom lines. On the other hand, State Street Corp fell 11% after its first quarterly results missed estimates. In deal news, Prometheus Biosciences jumped 70% after Merck and Company announced its acquisition of the biosciences company in a $10.8 billion deal. Roblox fell 12% after warning that its gauge of revenue, average bookings per daily user in March, is expected to fall year over year. All right, so that's the scoop on Wall Street today. Dive a little deeper. Dollar climbs as bets on Fed rescue nearing crossroads. And in this article, what they're hoping for is that the Fed's going to come right into the rescue with a big pile of cheap money, meaning low interest rates, and hopefully in their mind, hopefully some QE, which free money that's dropped out of helicopters is always nice. Really helps the economy. That's sarcasm, in case you're not really up on that. All right. On Monday, the U.S. dollar rebounded, reversing the trend of bearish bets that had previously pushed it to a one-year low. The U.S. dollar index rose by 0.54% to 101.8 after falling to its lowest level since April of 22 on Friday. The recent slump in the dollar was driven by bets that the banking crisis would lead to a fall in lending standards and economic growth, forcing the Federal Reserve to rescue the economy with rate cuts. Again, hope. However, this hasn't happened, and the focus has now shifted to elevated inflation that is likely to keep interest rates higher for longer. Goldman Sachs believes that the market is pricing in a narrow path of small slowdown, but more accommodative policy, and that is likely to come to a fork in the road soon. They added, while the Fed officials were concerned in March, most of the commentary since then has noted that the tightening in lending conditions appears mild so far, and that they continue to view bank failures as relatively idiosyncratic. Data from last week also showed that banks have cut back borrowing from the Fed's emerging lending program, signaling that turmoil in the banking sector has somewhat eased. MFUG, on the other hand, believes that fears over the impact of tighter credit conditions will weigh heavily on the dollar and point to a recent small business survey showing a sign of cracks in lending activity and recent data showing cooling inflation as a reason for the Fed to pause. In conclusion, the recent rebound in the U.S. dollar suggests that some on Wall Street believe bets on Federal Reserve rate cuts and a soft landing are nearing a crossroads. Yeah, fat chance. While there are still concerns over the impact of tighter credit conditions, recent data has shown that the banking sector's turmoil has somewhat eased. However, the market is still concerned about the direction the Federal Reserve will take regarding interest rates, and it remains to be seen how this will impact the dollar's value. Well, if I were to take a guess, the dollar was falling before all this madness started 3 years ago. And, my guesstimate is that, the dollar is the best of all the other crap out there. It uses currency and not money, currency. And until we get back on a sound money system, I just don't think it's going to get much better. All right. Last up, what if the dollar fails? So that's with all the talk about, Saudi Arabia and China and all these other countries using the dollar less. Macron, he said he was planning on, exiting the dollar, I think, in a conference last week. I know there was some scuttlebutt about that. So let's go ahead and dive into this and see what they have to say. Recently, many major countries have moved away from the U.S. dollar, raising questions about the dollar's longstanding role as the global reserve currency. The U.S. dollar has been the global reserve currency since the 1940s. That was the, what's the name of that? It's the Brent, I can't remember the name of it at the moment. The reserve currency status looks great on paper as it allows the country to print stacks of paper and exchange it for other goods. But in reality, the profits go to whoever is printing the money. The profits are then handed to the U.S. Treasury and Wall Street commercial banks. If the dollar were to lose its position as the global reserve currency, it would be catastrophic for the American economy and the American people and subject billions of foreigners to history's greatest bait and switch. In late March, Saudi Arabia announced it would price oil in Chinese yuan, which raised concerns about the dollar. If foreigners don't want dollars, the Federal Reserve and banks could only print a little bit, since printing a lot would create inflation and voters would react. But if foreigners want a large amount of dollars, the Fed and banks can print a matching amount. The situation is like a river flowing into the money supply reservoir, matched up with the river flowing out to foreigners. The reservoir stays stable and voters do not riot. However, the profits go to the U.S. Treasury and Wall Street. If the dollar loses its status as a global reserve currency, foreigners won't need it as many dollars, meaning there won't be as many extra dollars nobody wants. And that's primarily the euro dollars, which are outside of our domestic monetary system. And if all of those euro dollars come back, you think we've had inflation the last 3 years. Just wait. This makes the price of the dollar fall, making it weaker. The process is slow at first, but picks up speed as a progressive rush for the exits. Americans will be left holding the bag as the dollar becomes increasingly worthless. They will be obligated to use the U.S. dollar unless they swap it for gold, Bitcoin, or goats. You can eat a goat. You can even trade for stuff. A falling dollar drives up the prices of everything that comes into America, as well as anything traded on the world markets, such as raw materials and imported components that drive American factories and sustain American consumers. Well, maybe if we built stuff here in America, we wouldn't have all these problems. But hey, it was much better to offshore all those jobs to cheap foreigners and put Americans out of work. Hey, it worked out pretty well for a few decades. Gasoline, heating fuel, and food prices, along with prescription medicines, would be the first to jump. Expensive commodities and input prices would pour out through the supply chain, increasing prices in industry after industry, such as cars, construction materials, clothes, furniture, TVs, computers, and medical devices. If foreigners get nervous, they sell not only dollars, but also assets denominated in dollars, such as stocks, bonds, and treasuries. Foreigners own about 40% of America's stocks and about 1/3 of corporate bonds. If foreigners start selling, both will plunge, which could cut 401ks almost in half, drive up borrowing costs for companies to impossible levels, and lead to mass bankruptcies on top of the wave. The consequences of de-dollarization could be catastrophic for the American economy, people, and foreign entities. But the reality is most people won't do anything about it until everything falls apart, and then they're standing there with nothing. But hey, some of us are prepared and ready for it, but can't help everybody. All right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope you have a wonderful evening, and I'll talk to you next time. Adios.